Hi, in this video, we'll discuss the purpose of using derivatives. So why do investors invest in derivatives? There are two main reasons for that. The first being risk hedging, and the second being speculation. So what is risk hedging in the first place? It's different from the diversification we have seen from the portfolio management. Hedging the risks does not eliminate risks. It does not reduce it. It does not make it disappear. But rather it shifts the risk to other parties. So the risks are still there. It's just not now you're not bearing it because of the derivatives. It's been shifted to someone else. But it's useful in many cases. So we'll still use the example of the rice market from the previous video, and we'll think of it from the perspective of the seller. So as the seller, without any derivatives or the forward contract, your payoff would be exactly the amount or exactly the price you are going to sell the goods. So basically the spot price is going to be your payoff without any derivatives. So let's represent it on a graph, and that's going to be here on the horizontal axis is your spot price, and your payoff is a 45-degree line upwards. Okay, and again we're standardizing it to the size of 1, or the transaction size of 1. Okay, so that's your payoff if you only have the underlying asset here. Okay, so that's the underlying assets payoff. So basically you get what you sell it for. But what if we combine it with a forward contract like we have seen from the previous video? So the payoff for entering the forward contract on the short position is going to be a 45-degree line downwards here. So with some sort of forward price here, so that's going to be a downward sloping straight line. Okay, so that is the short position of your forward. So let's combine these two, and what do we get? So we would get a payoff that is exactly the same as your forward price. Okay, and that's going to be the payoff here, and that's the forward price. So how do we interpret this? With the increase in the price of your underlying asset, you could basically gain more by just selling it, right? But it's offset or hedged by entering this short forward, or by shorting this forward contract. So the higher the spot price, the lower the value or lower the profit for entering this contract. So these two will offset each other, and they add up to exactly your forward price, because they're both 45-degree straight lines here. Okay, so why do we need this, and why is it risk hedging? Because no matter the market outcome, no matter the spot price, the seller here will be able to confirm, or will be able to know for sure that he will receive that forward price as his final price when the contract matures, or at the date of maturity. So this basically removes a bit of uncertainty from the seller's side, which is good for the seller if he is going to engage in some sort of budget planning or some sort of strategic planning, so he knows what's going to happen in the future, rather than being in the dark and placing bets, right? So this helps the seller, and to some degree the buyers as well, to plan for the future, because now they know what they're going to pay or what they're going to receive in the future. So it helps them to remove some of those uncertainty here. Okay, so that is why we need risk hedging here, and that's one of the main purposes for investing in derivatives. But this is only a very simple example. We will see more of these combining derivatives with your underlying assets in the future. Okay, and it's not just forward. And the second purpose is naturally speculation. So as we have seen from the previous video, you could potentially make a fortune if the market price or the spot price is very different from the forward price. Yeah, both as a buyer and as the seller. but it's basically a gamble or placing a bet on the prices here, right? So with a simple forward, you could be gaining a lot of money or a lot of profit from the forward contract, or you could be losing as well. And forward is not the only instrument or the only derivatives that you can use as a tool of speculation. You could use other different derivatives, and you can also create derivatives based on derivatives. So that could amplify the payoffs and also amplify the losses from it. So it's going to be a bigger gamble, which will not go into too much of detail here, right? So we have talked about, hedging the risks, but there's always the risk of default. So the forward contract here is a bilateral agreement. So it's only agreed upon by two parties, right? The buyers and sellers. But as we have discussed before, there's always a possible incentive for either side to deviate or not to honor the contract. That is by default in the contract, because they might seem and they might see the contract as not worth it, right? So, for example, if the forward price and the spot price is going to be very different and is going to benefit one side too much and is costing another side too much, then the losing side might not be able to or might not be willing to honor this forward contract. So they might choose to default, right? So there's always the risk of default here, and it's more or less not very regulated, but it's better after the 2008 financial crisis. So how do we tackle with this possibility of default here, right? And we could sort of use the upgraded version of the forward contracts, which is called the future contracts. Okay, the futures or the future contracts are standardized, exchanged contracts, and their exchanges happens not just at the maturity, but on a daily basis. Okay, so we have more frequent exchanges, and we have regulations, we have standardized contract, and they can be traded on the exchanges as well. So this gives them a great deal of liquidity and transparency, and of course authority, because it's regulated by relative authorities here. Okay, relevant authorities here. So as for futures, we're not going to the details of how the futures will be priced and how they work, but it's enough to know that there's another type of derivatives called futures. They're basically forwards, but they are regulated and they're supervised by third party, an authorized third party, and they're exchanged frequently, and they are standardized. So it's going to be safer this way. So the risk of default is somehow protected here, or somehow limited. Okay, so this is why people or investors would buy or invest in derivatives. So the two main reasons you would need to know is because of risk hedging and speculation. Okay, and I'll see you in the next video.